Welcome to my presentation on taxation of partnership. If you are coming across my lecture for the first time, please don't forget to like the video, subscribe to the channel so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. What is partnership? Partnership is an association of two or more persons. An association of two or more persons who come together in order to run a business with a view to making profit. An association of two or more persons who come together, they put their resources together in order to run a business with a view to making profit. According to the Partnership Act 1890, partnership is a relationship that exists or subsists between persons who carry on business in common with a view of profit. That is the definition of partnership according to the Partnership Act 1890. Now, in any partnership business, the minimum number of people to form a partnership business is 2. Minimum of 2 and maximum of 20, except for a professional partner. A professional partnership business might have more than 20 members. So now we want to look at the various technologies used in partnership business. But before I go into that, let me look at the Ds of partners. What do we mean by Ds of partners? The Ds of partners is a document in the form of the general rules and regulations that govern the partnership business. The rules and regulations that govern the partnership business is said to be the Ds of partners. So the general rules and regulations that govern the partnership business is said to be the Ds of partners or partnership Ds. Now, what are the contents of partnership Ds? What are those things that are expected to be, or what are those things that the partnership Ds is or are expected to contain? Number 1, the amount of capital to be contributed by each partner. Amount of capital to be contributed by each partner. This must be spelled out in the Ds of the partners. Number 2, the rate of interest on capital. The rate of interest on capital. Interest on capital. This must be spelled out in the Ds of partners. Number 3, the rate of interest on drawings by a partner, where any partner withdraw any resources from the business or from the partnership business. The rate at which interest will be charged on such drawings, this must be spelled out in the Ds of partners. Then the profits or losses sharing ratio. Profits or losses sharing ratio. This must equally be spelled out in the Ds of partner. Rate of interest on loans provided by a partner. Rate of interest on loans provided by a partner. Rate of interest on loan provided by a partner. This must equally be spelled out in the Ds of the partners. Number 6, the salary or remuneration payable to any of the partners. Salary payable to any of the partners. This must be spelled out in the Ds of partnership. Remember, I've told you that the gist of the partner or partnership gist, I've told you that it is the document that governs the operation of the partnership business. The document that governs the operation of partnership business. What will happen if there are no deeds of partners? Absence of partnership deeds. So, in cases or case where there are no deeds of partners, what should the partnership do? Number two, each partner is to contribute the same amount. Each partner is to contribute the same amount. They should contribute the same amount where there are no deeds of partner. Number two, no interest on capital. No interest on capital. No interest on capital where there are no deeds of partner. No interest should be charged on drawing. No interest should be charged on drawings by a partner. So where partner may withdraw, there will be no interest on that drawings by the partners where there are no deeds of partners. Number four, no partner is entitled to salary. No partner is entitled to salary. No salary should be paid to any of the partners where there are no deeds of partners. Profits or losses should be shared. Equally. They should share profits or losses equally where there are no deeds of partner. Number six, interest at the rate of 5% on advances by the partner. Interest at the rate of 5% on advances made by a partner. Interest at the rate of 5% on advances made by a partner. So all these should be taken note of where there are no deeds of partners. So what is the relevant tax authority? Relevant tax authority. The relevant tax authority is the tax authority of the territory in which the principal office of the partnership business is situated. The tax authority of the territory in which the principal office of the partnership business is situated. Remember, partnership business is governed by the Partnership Income Act. Personal Income Tax Act. Personal Income Tax Act. Taxable income of partners. Taxable income of partners include, number one, remuneration. Remuneration paid or payable to a partners. Remuneration paid or payable to partners, e.g., salary paid to partners. Number two, cost of passage to or from Nigeria. Cost of passage to or from Nigeria. Cost of passage to or from Nigeria, that is passage and leave allowance. Interest on capital. Interest on capital given to a partner. Then interest on loans. Interest on loans given by any of the partner. Number 5, share of profit. Share of profit or losses of the partner, of the partnership business. These are the taxable income of partnership business. What are the steps for computing the tax liability of a partner or a partnership business? Now let's look at the steps. The first step is to compute the adjusted profit or loss of the partner. Steps for computing the tax liability or tax payable of the partnership business. The first step is to compute the adjusted profit. Compute the adjusted profit or losses of the partners or the partnership firm. You compute the adjusted profits or losses. So, for better understanding, I will advise you watch my earlier presentation on computation of adjusted profit of a company. You'll be able to know more about the allowable expenses and non-allowable expenses. Or you watch my presentation on company income tax, adjusted profit. So, you compute the adjusted profit. No, those expenses that are not allowable, you add them. Those ones that have been charged, allowable expenses deducted in the accounts. Not allowable expenses deducted in accounts, you add them back. While the allowable expenses not previously reported, you deduct them. So for better understanding, please watch my earlier presentation on the computation of adjusted profits of a company. Then you deduct your capital allowance. You deduct capital allowance, from the adjusted profit. From the adjusted profit or losses computed to arrive at distributed or distributable profit. These distributable profits will now be shared in accordance with the provisions in the partnership deeds. You share it in their profits or losses sharing ratio. And I've told you what to do where there is no deeds of partners. That is, you share it equally if there are no deeds of partners. But if there are deeds of partners, you share it in accordance with their profits or losses sharing ratio. You share the profits between or among the partners. The profits or losses between or among the partners. So these are the steps you need to follow when you are computing your tax liability or tax payable by the partners. Now, I want to give you the format for the computation of chargeable income. I've told you that this partnership taxation, I've told you it is similar to taxation of sole trader. If you want to learn better or more about this, you can as well watch my earlier presentation on taxation of a sole trader. Now, computation of chargeable profit XYZ Limited. Computation of chargeable profits for 20XX year of assessment. I told you should avoid putting relevant year. Examiner in their question will put relevant year, but for your purpose, you don't need to put relevant year. You have to state your year of assessment. Now, let's assume A and B, if they are the partners, A and B. Then you start with and income. And income. Your earned income includes salary. Let's assume the salary is paid to A. Then passage and leave allowance, if any. Passage and leave allowance, if any, paid to the partners. Passage and leave allowance. Then interest on capital, if any. Interest on capital to A and B. Then after interest on capital, you have share of profit. Share of profits. How much is received by A and the amount received by B. You sum up that, you arrive at the total earned income. This will give you the total earned income. After earned income, you have unearned. Unearned income. Unearned income include interest on loans. Interest on loans. Let's assume the interest on loan was paid to B. Then, if you want to know other items that you can have here, I will advise you watch my presentation on taxation of sole trader and personal income tax. So, for better understanding. So, when you add this and this, you arrive at the total income. Then, after this total income, you deduct the tax exempt item. Tax exempt items. Tax exempt items include National Housing Funds contribution. National Housing Funds contribution. NHFC. So, you deduct that. National Housing Funds contribution. National Pension Funds contribution. National Pension Funds contribution. National Pension Funds contribution. You deduct that, if any. NPFC. National Pension Funds contribution. National Health Insurance Scheme contribution. National Health Insurance Scheme contribution. These are tax exempt items. You deduct them. Then you also have life assurance premium. Life assurance premium. Life assurance premium. So, life assurance premium. Then after deducting that, you arrive at the gross income. Gross income. Gross income. Gross income. From the gross income, you now less the consolidated relief allowance. You less the consolidated relief allowance. You deduct that from the gross income, consolidated CRA. So when you deduct that, you arrive at the chargeable income. Chargeable income. How do you compute your CRA, consolidated relief allowance? Consolidated relief allowance is usually higher of 200,000 naira or 1% of gross income. You choose the higher of these two. 1% of gross income, you compare it with 200,000, whichever one is the higher, you pick that. Now add 20% of gross income. If you add 20% of gross income, you arrive at your CRA, consolidated relief allowance. Then you apply your tax rate. You apply your tax rate to get your tax payable or tax liability. Tax rate now. Tax rate, you apply the personal income tax rate. First 300,000 naira. First 300,000 naira will be taxed at 7%. Next 300,000 naira will be taxed at, if you have 4%, so 7%, you have 11%. Next 500,000 naira will be taxed at, add 4 to it, you have 15%. Next 500,000 would also be taxed plus 4, that is 19%. Next, if you add this plus this, 1 million plus 1.3, 1.6. Next 1.6 million will be taxed at, add 2 to it, not 4 again, till you have 21%. Then next, if you have 1.6 plus this, plus this, plus this, plus this, you have 3.2 million. Will be taxed at, add 3% to it, then you have 24%. Fadeke, Femi, Kola, and Benga have been in partnership as medical practitioners for 8 years. The statement of profit or loss for the year ended December 31st, 2021 is as follows. Gross income of 224,500,000. Direct expenses of 48.7 million naira. We have the gross profit of 175,800,000 naira. Deduct salaries and wages of 72 million. Rent and rates of 1.5 million. Transports and traveling 825,000 naira. Telephone and telex 210,000 naira. Motor running expenses of 680,000 naira. Allowance for doubtful debts 310,000 naira. Miscellaneous expenses of 1,450,000 naira. Other professional charges of 360,000 naira. Audit fees of 500,000 naira. We have bank charges and commission of 1,122,500. Depreciation of 1,240,600. Interest on loans. Fadeke 300,000. Femi 240,000. Kola 180,000. Benga 150,000. Interest on capital. Fadeke 1,250,000. Femi 1,250,000. Kola 1,250,000. Benga 1,250,000. Passage and leave allowance. Fadeke 660,000. Femi 660,000. Kola 660,000. Benga 660,000. The total of all the expenses is 88,708,100. After deducting the expenses from the income approved, you have the net profit for the year of 87,091,900. This question is obtained from ICAN May 2023. Taxation skill level. So you can download it from the ICAN website. Additional information. 1. Included in salaries and wages is 1.2 million naira paid for each of the partners. 2. Rent and rates comprise rent paid to partner Padike 1,440,000. Rates 60,000. The total is 1.5 million. Note 3. Miscellaneous expenses. This include donation to a church in the hometown of Fadike 50,000 naira. Donation to a church in the hometown of Fadike 50,000. Allowance paid to domestic staff Femi 240,000. Cost of repairs and maintenance of the residence of each partners totaling 840,000 naira. Office repair, that is 320,000. The total is 1,450,000 naira. Number 4. Capital allowance agreed with the revenue was 980,000 naira. 5. Profits are to be shared equally among the partners. 6. Fadeke and Femi are married with 3 and 2 children respectively. 4. Fadeke has a life assurance policy of 960,000 naira on which she pays 96,000 naira annually as premium. 8. Fadeke maintains her aged father who is over 68 years required. For the relevant assessment year, compute the income of the partnership. B. Compute the income tax liability of each of the partners. This question is obtained from ICAN May 2023. Taxation, skill level. You can download the Pathfinder from ICAN website. Sorry, I want to make this correction on the title or heading of the solution. I mistakenly put 2021 year of assessment instead of 2022 year of assessment. Please take note. The correct year of assessment is 2022. If you go back to the question, you were told that the statement of profit or loss for the year ended December 31st, 2021 is as follows. Since you are given the year in 2021, remember the profit of the business will be assessed on preceding year basis, PYB. Therefore, the profit for 2021 will be assessed in 2022. So the year of assessment is 2022. I've told you that it's under must. You put your year of assessment. And it is wrong if you put December 31st. So it is just the year you have to state. You don't need the month. So computation of the income of the partnership for 2021 year of assessment. Or you put 2021 tax year. So we have, let's put Naira. Net profit for the year, 87,091,900. So now let's start with net profit. Net profit as per account. It is 7,091,900. So we now add back no allowable expenses. You add back no allowable expenses. Now, let's go through the statement of profit or loss. This is gross income and this is direct expenses. Salary is allowable. Rents and rates is allowable. Transport and traveling is allowable. Then we have telephone and telex is allowable. Motor running expenses is an allowable expenses. Allowance for doubtful debts, 310,000. We are not being told whether this allowance is specific. So we assume it is general. Where it is not indicated that the allowance is specific, you assume it is general. So we have allowance for doubtful debts. I've told you that general provision for doubtful debts, I've told you it is not allowable for tax purpose. So we are going to disallow that, 310,000. So we have allowance for doubtful debts, 310,000. 10,000. Back to the question. Miscellaneous expenses is allowable. Other professional charges, 360,000 is an allowable expenses. Audit fees is allowable. Bank charges and commission is allowable. Depreciation is not allowable. 1,240,600. So we have depreciation. 1,240,600. Then interest on loans. Fadike, Femi, Kola, and Benga, they are an allowable expenses of partnership business, but they are taxable. They are taxable in hands of the recipient. Interest on capital is an allowable expenses of the partnership business, but it is taxable in the hands of the recipient. Passage and leave allowance is allowable to the firm, but it is taxable in the hands of the partners enjoying that allowance. The net profit has been used. Additional information. 1. Included in salaries and wages is 1.2 million paid for each of the partners. This is the salary paid to the partners. So it is allowable to the firm, but it is taxable in the hands of the individual partners. Rent and rates comprises rent paid to partner Fadike. Rent paid to Fadike is taxable in hands of Fadike, but it is an allowable expenses to the firm. Rate is allowable. Then 3. Miscellaneous expenses. This include donation to a church in the hometown of Fadike, 50,000. Donation to church is not allowable. So we have donation to church in hometown of Fadike that amounted to 50,000 naira. Then we also have allowance paid to domestic staff. Allowance paid to domestic staff of Femi, 240,000. This is just like drawings. It's not allowable. So allowance to domestic staff, 240,000 naira. Then we also have cost of repairs and maintenance of the resident of each partner. This is personal resident. Repairs of their personal resident is not allowable. Repairs and maintenance of personal resident of each 40,000 naira is not allowable for tax purpose. Office repairs, 320,000 is allowed. It's an allowable expenses. 4 is capital allowance. Notified profits are to be shared equally among the partners. That is the profits or losses sharing ratio. Fadike and Femi are married with 3 and 2 children. So we don't need that information since children allowance is no longer granted. All those allowances have been consolidated. That is why we now have consolidated relief allowance. 7. Fadike has a life assurance policy of 960,000 naira, on which she pays 96,000 naira annually as premium. Tax exempt item. Annual premium paid is one of the items that will be exempted from tax. So that will be considered later. Note 8. Fadike maintains her aged father who is over 68 years. So I've told you dependent relative allowance is no longer granted. It has been replaced with consolidated relief allowance. I've told you all other allowances such as personal allowance, children allowance, dependent relative allowance, and other allowances, all of them have been consolidated to have the consolidated relief allowance. So this information is no longer relevant in the current tax provisions. Required for the relevant assessment year, A, compute the income of the partner. Now let's sum up all the Non-allowable expenses. We have 310,000 naira plus 1,240,600 plus 50,000 plus 240,000 plus 840,000. That is total 2,680,600. So if you add it to the net profit as per account plus 87,091,900, then we have the adjusted profit to be 89,772,500. That is our adjusted profit. Adjusted profit. Let me reconfirm that. 87,091,900 plus 2,680,600. We have 89,772,500. That is our adjusted profit. From our adjusted profit, we less capital allowance. Less capital allowance. Capital allowance. How much is the capital allowance? Note 4. Capital allowance agreed with the relevant revenue was 980,000 naira. That is capital allowance, 980,000 naira. If you deduct the capital allowance minus 980,000, there you have 88,792,500. 792,500. That is the distributed profit. Distributed profit. That is the profit of the partner that is available for distribution. This profit will now be shared among the partners in their profits or losses sharing ratio. What is the profit or losses sharing ratio of the partners? Note 5. Profits are to be shared equally among the partners. How many are they? We have Fadike 1, Femi 2, Kola 3, Benga 4. Since there are 4 partners, each of the partners will receive 1/4, 1/4, since the profits or losses of the partners are to be shared equally. Now, let's have share of profit. Share of profit. We have Fadike 1/4 of the profit of 88,792,500 divided by 4. You have 22,198,125. Then the second partner is Femi. Femi also will receive 1/4 of the profit. That is the same amount. Since they share profits or losses equally. The third partner is Kola. Kola will equally receive 1/4 of the profit. 22,198,125. While the fourth partner is Benga. Benga will equally receive 1/4 of the profit. That is 22,198,125. If you sum up the profits, you'll be having 88,792,500. So that is all about the solution to the part A. The part B, you are to compute the income tax liability of each of the partners. Be part of the question. We have Fadike, Femi, Kola and Binga, and Binga. So you have to compute the tax liability. So let's have computation of the tax liability of the partners for 2022, sorry. Remember, it is preceding year basis. So the year of assessment will be 2022. For 2022, year of assessment. Remember, the profit or loss we are given is for 2021. So you compute the tax liability for 2022. So we have the first partner is Fadike. The second partner is Femi. The third partner is Kola. The fourth partner is Binga. So we start with earned income. Earned income include, so the profit share among the partner is 22,198,125 for each of the partner. So we have share of profit. Share of profit 22,198,125. 22,198,125 for each of the partners. 22,198,125. 22,198,125. We have interest on capital. Fadike 1,250,000. Femi 1,250,000. Kola 1,250,000. Binga 1,250,000. So we have interest on capital as part of our earned income. Interest on capital. Each of them have 1,250,000. 1,250,000. 1,250,000. 1,250,000. Then we have passage and leave allowances. Fadike 660,000, Femi 660,000, Kola 660,000, Binga 660,000. Passage and leave allowance. Passage and leave allowance 660,000 each. 660,000. 660,000. That is earned income. Then we have the net profit. Let's go through the footnote. Additional information. Included in salaries and wages is 1.2 million paid for each of the partners. This is salary paid to the partners. That is their remuneration. Salary. Each receive a salary of 1.2 million. 1.2 million. 1.2 million. 1.2 million. 1.2 million. Each of them receives a salary of 1.2 million naira. Note 2. Rent and rates comprises rent paid to partners Fadike, rent is an unearned income. If you have watched my earlier presentation on personal income tax, we have made mention of rent, interest, dividends, all those ones. They are unearned income. So we are going to consider that as part of our unearned income. Miscellaneous expenses, this include donation, we don't need that. Allowance paid to domestic staff, we don't need it. Cost of repairs and maintenance, we don't need it. Office repairs, we don't need that. So, cut here. For capital allowance, agree with relevant revenue has been considered. Profits or losses profits are to be shared equally. That have been used. Fadike and Femi are married. I've told you that this information is no longer required. Fadike has a life assurance policy of 960,000. That will be considered as the premium paid will be considered as part of tax exempt item. Fadike maintains aged father. I've told you that information is no longer required. It's now required. Now we've considered all the earned income items. So let's sum up our earned income. 22,198,125 plus 1,250,000 plus 660,000 plus 1.2 million naira. So for Fadike, our earned income is total 253 and 25 million 308 125. For Femi, 22,198,125 plus 1,250,000 plus 660,000 plus 1.2 million. We have 25 million 308 125. For caller, 22,198,125 plus 1,250,000 plus 660,000 plus 1.2 million. So we have 25 million 308 125. Okay, they have the same items, so this one also the same items, so it will still be 25 million 308 125. That is total earned income. Total earned income. After earned income, you have unearned income. Unearned income. Now back to income statement. We have bank charges and commission 1,122,500. Depreciation 1,240,600. We don't need that. We have interest on loans. I've told you that interest on loans is unearned income item. 300,000 for Fadike, 240,000 for Femi, 180,000 for Kola, Benga 150,000. So we have interest on loans. Interest on loans. 300,000 for Fadike, 300,000. Femi 240,000. Then Kola 180,000. Then Benga 150,000. That is their interest on loans. Rent and rates comprises rent paid to partner Fadike 1,440,000. Rent paid to Fadike is an unearned income. So we have rent 1 million. Fadike, 1,440,000. Only Fadike receives that rent. Rate is an allowable expenses. Fadike has a life assurance policy. So this is tax exempt item. The premium paid is a tax exempt item. We don't need the principal sum. We only need the annual premium paid as tax exempt item. No, we are on an unearned income, so we won't use that yet. Total income. $25,308,125 plus 300,000 plus 1,440,000. We have 27,048,125. Then for Femi, 25,308,125 plus 240,000. That is total 25,548,125. Then we add for that of color 25,308,125 plus 180,000. That is totaled 25,488,125. Then that of Gbenga, 25,308,125 plus 150,000. That is totaled 25,458,125. Then the next item is tax exempt item. We only have one item to be considered in this question. But for better understanding, watch my earlier presentation on personal income tax and taxation of sole trader. Then you will also learn how to identify the adjusted profit and allowable expenses and non-allowable expenses in my presentation on company income tax. Fadike has a life assurance policy of 96,000. This is the principal sum, on which she pays 96,000 annually as a premium. The annual premium paid is a tax exempt item. Therefore, the 96,000 will be considered as tax exempt deductions. Life assurance premium, that is Fadike, 96,000. So we now have gross income. Gross income. If you deduct 96,000, 27,048,125 minus 96,000. Then you have 26,952,125. Then 25,548,125. Then this one is 25,488,125. Then this is 25,458,125. Now, from the gross income, you deduct the consolidated relief allowance. deduct CRA, consolidated relief allowance. Consolidated relief allowance. Consolidated relief allowance for Fadeke. We said consolidated relief allowance. We said it is the higher of 200,000 naira. Higher of 200,000 naira, or 1% of gross income. How much is the gross income of Fadeke? The gross income of Fadeke is 26,952,125. 26,952,125. 26,952,125. 1% of that will be 269,521. 1% of this, 1/100 times this, it will be 269,521.25, approximately equal to 269,521. The higher is this. This will be chosen. Since it is higher than 200,000, it's greater than 200,000. So we choose this plus 20% of gross income. The gross income of Fadeke is 26,952,125. 20% of that, 26,952,125. 20% of that gives us 5,390,425. 5,390,425. If you now add it to this, plus 269,521, that is totaled 5,659,946. That is the consolidated relief allowance of Fadeke. Consolidated relief allowance Fadeke is 5,659,946. If you now deduct that allowance from the gross income of 26,952,125, you have the chargeable income. 21,292,179. That is the chargeable income. Chargeable income. The gross income of Femi is 25,548,125. So Femi, 1% of gross income of Femi, which is 25,548,125. 1% of this will give us 255,481. 1% of the gross income of Femi is 255,481, which is still greater than 200,000. Since it is greater than 200,000, this will be used. But where 200,000 is greater than this, then you use 200,000 instead of this. So then plus 20% of gross income. Gross income is 25,548,125. 20% of gross income of 25,548,125. 20% of that gives us 5,109,625. If you now add it to 255,481, the consolidated relief allowance of Femi will be 5,365,106. That is the consolidated relief allowance of Femi. So the consolidated relief allowance is 5,365,106. If you deduct that from the gross income of Femi, the gross income is 25 million. If you subtract that from 25 million, 548,125, the chargeable income of Femi will be 20 million 183,019. The top person is caller. Consolidated relief allowance of caller, 1% of gross income. How much is the gross income of caller? 25,488,125. 25,488,125. The 1% of that is 881, which is still greater than 200,000. So this will be considered. 20% of gross income of caller, 25,488,125. 20% of 25,488,125. That gives us 5,097,625. If you add it to this, it was 254,881. That is total 5,352,506. 5,352,506. 5,352,506. So if you subtract it from 25,488,125, that is total 20,135,619. That is for caller. Then the fourth person is Benga. The gross income of Benga is 25,458,125. 1% of that, 1% of 25,458,125. That is 254,581, which is still greater than 200,000, plus 20% of gross income, and gross income is 25,458,125. 20% of that, 25,458,125. 20% of that gives us 5,091,625. Then if you add it to this, 254,581, then you have 5 million 346 206. 5 million 346,206. If you deduct it from this 25,458,125, then you have 20,111,919. Payable. We have Fadike. There are 4 of them. 2, 3, and 4. The first person is Fadike. The second person is Femi. The third person is Kola. And the fourth person is Benga. So, first 300,000 naira. First 300,000 naira will be taxed at 7% based on the tax table. 7% of 300,000, that is 21,000. 21,000. 21,000. 21,000. Remember, the chargeable income of each of the partners is 21,292,179, 20,183,019. All of them were having over 20 million as their chargeable income. So we've considered 300,000 naira so far. Not close to that yet. Next, 300,000 naira at 11%. 11% of 300,000, that is 33,000. 33,000. 33,000. 33,000. You've considered 600,000 naira so far out of the income of over 20 million. Next, 500,000 naira will be taxed at 15%. 15% of 500,000. That gives us 75,000. 75,000. 75,000. 75,000. What have been taxed so far is this plus this 600 plus this 1.1 million. 1.1 million has been taxed so far out of an income of over 20 million. Then we have next 500,000 again, which will be taxed at 19%. 19% of 500,000. That gives us 95,000. 95,000. 95,000. 95,000. 95,000. So if you sum up this is 1 million, 1.3, 1.6 million have been taxed out of income of over 20 million for each of the partners. Each of the partners. Now, next 1.6 million will be taxed at, if you add 3% to this, it will be 21. I mean, if you add 2% to it, it will be 21%. Will be taxed at 21%. 21% of 1.6 million. That gives us 336,000 for each of the partners. 336,000. 336,000. 336,000. if you add this plus this plus this plus this plus this, that is 3.2 million. Now, what have been taxed so far? What is there? Let's sum it up. What have been taxed so far is 3.2 million. 336,000 plus 95,000 plus 75,000 plus 33,000 plus 21,000. We have 560,000. 560,000. Let me reconfirm that. 21 plus 33 plus 75 plus 95 plus 336. 560,000. That is the amount of tax computed so far. 560,000. And the income that have been taxed so far is 3.2 million. That is first 3.2 million. Is what gives us all these tasks. They've taxed 3.2 million. Then anything, the next 3.2 million or above 3.2 million will be taxed at 24%. Then for Fadeke now, Fadeke, the chargeable income of Fadeke is 21,292,179. That is the chargeable income of Fadeke. 21,292,179. Then the balance now. We want to tax the balance now. Balance for Fadeke now. Fadeke 21,292,179 minus, we said 21,292,179 minus 3.2 million that have been taxed so far. 3.2 million that have been taxed so far. Then what you have now, you now apply 24% of that times 24%. Let's subtract 21,292,179 minus 3.2 million. We are left with 180,921. 80,092,179. 24% of that. 24% of that gives us 4,342,123. If you add it, okay, for Femi is the next person. The gross income of Femi, the chargeable income of Femi is 20,183,019. 20,183,019 minus 3.2 million which have been taxed earlier. Then the remaining balance, now apply 24% of it. 20,183,019 minus 3.2 million will give you 16,983,019. 24% of that gives us 4,075,000. 4,075,925. For Kola, the chargeable income of Kola is 20,135,619. 20,135,619 minus 3.2 million which have been taxed earlier. Then times 24%. Let me confirm. 20 million 135,619. Let's subtract 20 million 135,619 minus 3.2 million. You have 16,935,619. 24% of that. So we have 4,064,549. That is for caller. The last person is Benga. The chargeable income of Benga is 20,111,919. We have 20,111,919 minus 3.2 million, which has been taxed earlier, then 24%. 20,111,919 minus 3.2 million times 24%. We have 4,058,861. So you sum it up to get the tax payable. For Fadeke, 560,000 plus 4,342,123 is totaled 4,902,123. That of Femi, we have 560,000 plus 4,075,925. That is totaled 4,635,925. For caller, 560,000 plus 4,064,549. That is totaled 4,624,549. For Benga, we have 560,000 plus 4,058,861. That is totaled 4,618,861. That is the solution to the question. Please don't forget to like the video. Thanks for watching ICAN.